Due to paucity of time, we'll move on to the most important talks which you're waiting for. Dr. Raju is here to present them.
Thank you, everybody. So, how many of you are doing stocks directly here? Anybody doing stocks? Okay, quite a few. So again, thanks to sir, he has made us to think independently. That's the one thing that we all owe to him. So first things first is to all of us must have a demat account open and understand the terms of the user interface, how to place a stock order, what is market order. All those things have to be learned. So these are all new things for those of us who are not exposed to the stock market. So it's always better to take guidance from a friend who has already done it before. So all of us have gone through this difficult journey. So how to select good quality stocks using MPTDS criteria or other criteria that we tell you basically. Basically you just try to get an hang of the things that are there rather than trying to remember. It's not possible to remember. These are like our OCT short forms. They keep changing and it's difficult. So why this topic is most of the times as retail investors we fall prey to tips trading, or we blindly follow some financial guru without understanding. The aim of this talk is to initiate and encourage ourselves to start learning about doing the stock selection on our own. And how to do it is to do a fundamental analysis of those stocks. So stocks can be simply, for the sake of classification in WealthCon, it could be banking or non-banking, and again in the non-banking it could be dividend paying or non-dividend paying. Even in the banking you can have dividend and non-dividend paying. So use the MPTDS criteria basically for the dividend paying stocks, and the non-dividend paying stocks use some other little bit extra criteria for them. That's it. So for the banking you don't use the debt equity ratio, we use gross non-performing assets, that the G stands for. I'll let you know about this. This criteria is basically to select fundamentally strong companies so that we don't risk losing our money. These are basically suited for passive investments. This is not for trading. This is not for trading. These are basically passive investment. And as we said, it's SIP, that is systematic investment plan, or a dip buying, that is whenever the things are down you buy them and you hold it for a minimum duration of 7 years. You think that this is a company which is going to grow over the next few years, and you should be ready to hold that for 7 years unless you feel or there is something that happens in between wherein we have to reconsider our decisions. So at WealthCon we are saying that to be very safe, have a market capitalization of more than 10,000 crores. So only very large companies we are actually trying to look at it, and the price should be uptrending, and the tax and the dividend and the sale should be ascending over the last 10 years. So how to do this? This website called as screener.in. Here you can see this is the chart of the price of TCS company over the last 10 years or so. Here you can see that although the prices have gone up and down, but the general trend is on the uptrend. So this is the kind of stock that we actually want to see. So if you are there invested for 7 years, even if you invested in 2018 here, still you would have made a profit when you are going there at the top of that year, somewhere there. But if you look at the another stock here, the ONGC, you can see that it's gone up and down, and the direction is it's going in any direction it wants. So it's not like a general uptrend that we usually see. But when there are limitations, some of the companies are mature and at a steady level of growth, they may have limited sales potential, growth potentials. So to diversify our portfolio, we also started to look at other criteria. So again, the market cap for the MD Sport criteria is more than 10,000 only. And for knowing the health of the company, 3 ratios we take. that is the debt to equity ratio, it should be less than 0.3. So that company is as debt free as possible is what we want. It should have a good operating margin. So it should have a good pricing power, should have a good operating margin, and whatever the capital it has employed, it should be able to generate a return on that capital employed. And it should have a consistent sales growth, it should be able to show profits, and it should also be paying the tax. So all these things are taken care, and these things are made into a mnemonic so that we remember it. So for the sake of return on investment, more than 20% is what we are taking it for screening, and for the sales, profit and tax, we are taking more than 15%. The growth year on year we are trying to see. So these are the various formulas. Let's not go into them, but you understand these are the formulas or the ratios that we are trying to find, and this we'll have to learn it ourselves and try to do it when we are doing it. So main aim of doing all these things again is to screen these stocks. Now after we screen, what we have done also, sir has done, is to give them points according to the growth that is there. Not every year you may have 15% growth, sometime you may have a 5% growth or a 10% growth. So based on that, there are scoring system. If this growth is less than 5%, we are given it as 0, and accordingly if it is more than 4, more than 20%, we are given it as 4. And after scoring all the values, so we are seeing that any stock which has got more than 75% points, then we are considered it as a valid stock, and in between 50 to 75 is in the watch list, and less than 50 we are actually discarding. So this is mainly to standardize the selection criteria and eliminate the risk of averaging because of inconsistent or volatile numbers. When it comes to banking, we do not use the debt to equity because the banks are actually giving debt. So we actually look at what is called as a gross non-performing assets. So they are given the loan and they are not got back the loan. So that's how it is actually. So lesser the gross non-performing assets, better for the company, and more the return on asset. So if you look at the screener and if you put this query there, market cap more than 10,000, you will get almost 451 results. And then if you, sorry, this is a video actually running. So if you see that the 451 companies came, then we put all our queries, then it brought it down to just 18. Now we need to go back and see each of these companies and see and download their profit and loss, and then put them into the Excel sheet again, and after that we need to look at the scoring. So if you looked at this scoring of this company called as Affle India Limited, which was there in the list, so it got a score of 86 here, and this is another company, this is the ITC got a score of 65. Again you need to do some individualization for each stock that you are looking at, because why it has got a lesser thing is because in the last 3 years or 4 years back, when there was a COVID, there's a huge dip, and because of that there is sales were less. So sometimes you may have to see the things in whole perspective when you are trying to select the stocks, because this company actually shows good return on investment, ROC is also growing, and the profit also and profit margins are also good for this company. So just because they had one bad year, you cannot discard it completely, but you may keep it in your watch list and take it forward. As far as passive investors are concerned, again, if you do not want to do all the stocks and other things yourself, then you can do what is called as passive investing into equity traded exchange traded funds, that is the ETFs. So you have the various ETFs called as Nifty 50, Next Nifty, all those things. We don't have to do anything. All we have to do is to buy them and hold them. That's it. And it is not based on any single company. It's the whole 50 companies which are there in the index, which will be based on that it will be doing it. So here again coming to the dip and the SIP buying, that what we are telling. So what you do is keep on investing a fixed amount, say 5,000, 10,000, 20,000, whatever it is at each time. But in dip buying, whenever there is a dip, as you can see here, the market was down, and here also the market was down. Here you can get in more money whenever the market is down. So that's the whole idea, to maximize your returns when you come here. So if you have bought more here, you will get more when you are going on the top. So that's the whole idea of the SIP and the dip buying. So in summary, it is basically we need to diversify so that the overall increase in the CAGR can happen. Have a selection of 20 to 30 stocks, become self-reliant, and have financial freedom. That's the whole idea of this.
Thank you, Raju. That was a very simplified talk. These terms may be new to you. You may feel they are very complicated and mere se nahi hoga. But believe me, 6th class, 7th class student or doctor's children, they are doing it. They are learning how to do it. So if they can, obviously we have to spend some time, and we can do it.